The stock market is closed today, Monday, February 9th, 2026. So we are looking at the official closing price for Datavault AI Inc. from the most recent trading session on Friday, February 6th. Datavault AI, trading under the ticker symbol DVLT on the Nasdaq, finished that session at 0.85 cents per share. This represents a staggering intraday surge of 32.86% from its previous close, a move that caught much of the market off guard and injected a massive dose of volatility into a stock that has been a lightning rod for debate over the last several months. While a 30% gain is enough to make any retail trader stop and stare, the real story isn't just the price action. It is the massive disconnect between the company's internal projections and the aggressive skepticism coming from institutional short sellers. The common narrative you will hear in most investor circles right now is that Datavault is just another speculative Web 3.0 and AI play riding the coattails of the broader tech rally. Many investors see the recent spike as a temporary reaction to a high-energy shareholder letter from the CEO, Nathaniel Bradley, which promised a jump in revenue from less than $3 million in 2024 to over $200 million by the end of 2026. To the average observer, these numbers look like classic small-cap hyperbole designed to prop up a struggling share price that is still down more than 75% from its 52-week high of $4.10. However, if you look deeper into the institutional positioning and the recent volume patterns, a far more complex picture emerges. On Friday, we saw over 138 million shares change hands, which is nearly double the average daily volume. This wasn't just retail frenzy. It was a high-stakes battleground where short sellers were likely being forced to cover positions as the stock blew past key technical resistance levels at 70 cents and 80 cents. The short interest in DVLT has been climbing steadily, recently reported at over 65 million shares, or roughly 12 to 16% of the public float, depending on which exchange data you prioritize. When a stock with that level of short pressure gaps up 30% on a Friday afternoon, it creates a gamma-like squeeze effect where the borrow rates spike and the cost to maintain a short position becomes prohibitive. Short sellers, most notably firms like Wolfpack Research, have built a thesis around the idea that Datavault's revenue targets are unsubstantiated and that its tokenization deals are more about press release optics than actual cash flow. They point to the company's negative net margins and a distressed Altman Z-score as evidence of significant liquidity risk. The counter-argument, and the one that fueled the recent rally, is that the company has secured a series of high-profile licensing agreements, including a $150 million strategic investment for AI supercomputing and partnerships with entities like Sports Illustrated and Silex. These aren't just minor deals. They represent a fundamental shift in how the company plans to monetize its portfolio of over 70 patents. Comment how many shares you currently hold and what your take is on the rising short interest in this particular name. Do you think the CEO's $200 million revenue target is a realistic milestone or just a way to keep the narrative alive while insiders sell? The institutional behavior here is particularly telling. While some major holders like Silex have trimmed their positions recently, we are seeing new stakes being established by firms like Prelude Capital and Anson Funds. This suggests that the smart money is divided. Some view the current sub-dollar price as a generational entry point for a company that could potentially control the infrastructure for real-world asset tokenization, while others see a short and distort opportunity where the company's lack of audited financial consistency becomes its Achilles heel. Retail sentiment on platforms like Reddit and X has remained surprisingly resilient despite the long-term price decline. There is a vocal contingency of investors who believe the company is being unfairly targeted by predatory short selling, often citing a fails-to-deliver data as proof of market manipulation. In early January, fails to deliver spiked to over 2.6 million shares in a single day, which often indicates that sellers are struggling to locate shares to settle trades. While retail coordination can't move a $500 million market cap on its own, it can certainly provide the fuel for a squeeze when institutional buyers decide to step in.
For those tracking the short data, it is essential to watch the borrow fee rates. When you see those rates climb into the double digits alongside a rising stock price, it is a signal that the shorts are feeling the heat. You can find this data on platforms like Fintel or through your brokerage's advanced trading tools. A sudden spike in the borrow rate often precedes a forced liquidation of short positions, which can lead to the kind of vertical price action we saw last Friday. However, the risk of chasing these moves is extreme. Squeezes are often violent but short-lived, and once the must-buy pressure from short covering subsides, the stock often reverts to its fundamental mean. Technically, DVLT is currently trading well below its 200-day moving average, which sits near $1.15. For the recent rally to be considered a true trend reversal rather than a dead cat bounce, the stock needs to reclaim and hold that dollar level on high volume. The upcoming catalyst that everyone is watching is the distribution of the Dream Bowl meme coin 2, an airdrop scheduled for late February. While the company admits these tokens may have no initial value, the move is a clear attempt to build a closed-loop digital ecosystem. Skeptics see this as a distraction, while supporters see it as the first step towards a proprietary exchange that could bypass traditional financial bottlenecks. Looking at the business model, Datavault operates at the intersection of blockchain and high-performance computing. They offer two main branches: data science, which focuses on Web 3.0 data management and biotech exchanges, and acoustic science, which handles spatial sound transmission for major venues. The bull case rests on the idea that as real-world assets like gold, diamonds, and even therapeutic data become tokenized, Datavault's patented information data exchange will become a mandatory layer for valuation and trade. The bear case is simpler. They are burning through cash and have yet to prove they can turn these strategic partnerships into consistent GAAP-compliant earnings. The future outlook for DVLT essentially boils down to three scenarios. In the first, the company hits its $30 million revenue target for 2025, proving the skeptics wrong and triggering a massive institutional re-rating that could send the stock back towards its $4 price target. In the second scenario, the company continues to issue high-level projections but struggles with execution and liquidity, leading to further dilution and a slow bleed back towards its 52-week lows. In the third, and perhaps most volatile scenario, the stock becomes a permanent battleground for short versus long interests, characterized by 30% swings in both directions based on fails to deliver data and social media sentiment. Investors should be wary of the meme label often applied to DVLT. While the company leans into crypto-adjacent initiatives like meme coin airdrops, its underlying patent portfolio and its expansion into 100 U.S. cities with edge computing nodes suggest a much more ambitious infrastructure play. The recent agreement with Available Infrastructure to deploy GPU-powered edge nodes in New York and Philadelphia is a tangible development that moves the needle beyond just Web 3.0 buzzwords. This infrastructure is designed to allow for tokenization at birth, where data is authenticated and valuated the moment it is created, reducing the reliance on public cloud providers like AWS or Azure. As we move towards the middle of 2026, the key metric to watch won't just be the stock price, but the revenue recognition in the quarterly filings. The CEO has made bold claims about underpromising and over-delivering, but the market is currently pricing in a significant execution discount. If the company can bridge the gap between its ambitious narrative and its balance sheet reality, the current sub-dollar price may look like a massive oversight. If they fail, the short sellers will have been right about the fundamental fragility of the business. The core takeaway here is that expectations and reality are in a state of high-speed collision. The market expects a speculative failure, while the company is reporting 148% year-over-year growth. The massive 32% gain on Friday was a shot across the bow to those betting on a total collapse. Whether you are a retail holder or just an observer, the volatility in DVLT is a masterclass in how short interest and aggressive management guidance can create a market environment where nothing is quite as it seems. The battle for $1 is just beginning, and with the borrow rates climbing, the next few weeks are likely to be even more explosive than the last. Would you like me to look into the specific details of the Wolfpack Research short report and the company's formal legal rebuttal to see which side has more merit?